Boom. Right. If you guys didn't see it, I did post the ebook, the beginner's ebook, in the Telegram channel again for you guys who missed it. And last night's session is also in the Telegram channel. Just look for the link in there. So right now we're just going to be using whatever chart one. This is the euro dollar. This is on the 4-hour time frame. And our main objective today is sort of like following on from what we did yesterday, and also just introducing something new in order for us to sort of like match up the two things and make sure that we have this added layer of probability. Okay, so with the more advanced stuff, right? I can say advanced, but it's actually quite simple. It's just that a lot of people find it very difficult to wrap their heads around. I mean, trading is just basically probability. Okay, trading is just probability, and if you can put the probabilities of the trade working out in your favor on a consistent basis, right? And if you can stack the probabilities of you making more money than you will be losing, right, with your bets, right? You call them bets. I know a lot of people try and shy away from terms like bet or whatever. They tend to associate trading with gambling, but there are things that are very common with trading as well as gambling. Okay, but we'll discuss that when we get to the probability part of things and how you can actually use probability in order to maximize the amount of money you can make in the market. And that, to me, is the ultimate edge. Okay, so we're looking at the big figures. I'm pretty sure we're familiar now with these big figures or the round numbers and what they basically mean. Okay, now, okay, let me grab the spotlight. Okay. Right, so what they basically mean, these big figures over here, right? 1, 11, 10, 50, 10 even, right? 11, 50. Don't get too confused when I say 11, 50 and then I say 1, 10 or 11 even or whatever the case may be. When I say just 11 even, just think of zeros, right? It's just basically an even number. So these big figures, or the major levels, major trading levels, as you can call them, obviously come about as a result of institutional sponsorship, or rather the big boys playing around those numbers, right? And those are usually psychological support and resistance levels. Like if the rand drops down to 13 rand, psychologically our brains will tell us that, okay, it's a bit undervalued, right? And if it drops down to 12 rand versus the United States dollar, we're going to figure, okay, it's extremely undervalued. Now it should be time to buy. And then when it goes up to about 16 rand, we're like, okay, it's extremely undervalued, overvalued rather. And we want to basically go short because we do believe it's going to go back down from 16 rand. USDs are going to go from 16 rand back down to 13 rand, and then from 13 rand back up to 16 rand. Yeah, so that is the psychological reasoning behind it, and this is obviously evident in the way that the market will then behave around these key significant levels, right? As you can see here, 13 November, market pulled below at 110 level and then pushed higher to break above 110.50, and is sort of like in between 111 and 110.50. Now, these major levels can be used quite effectively as support and resistance. Okay. Now you can use these levels, right? Not all of them, because not all of them are basically going to hold up, and not all of them are going to hold up all the time, because you might see a market getting broken or a significant level. What you thought was a significant level, you're like, okay, this one's a solid one, and the market just, the dam breaks and then the market starts sliding down, and you're like, okay, I thought the price was going to hold at this 110 level. So what you want to be is in a position to be able to maximize or to take advantage of the times that the market comes to those particular support and resistance levels and is rejected. Okay, there's a few things that you have to take into consideration before you take a significant trading level along with your trading pattern and then link them together, right? There's a few other things that you need to take into account. We will go over them briefly today as well, okay? I have explained trend, I don't know how many times, and I will continue to do the same thing because I do feel like it's a very important part of any sort of methodology. Now, right now we're obviously still focusing on maximizing opportunities on breakouts. So we are looking for a support level if the price is, let's say, above. Okay, so as the market is at 110.64, we would be looking for a significant support structure. Here we find it at 110, right? And another one would find it 109 even. Right. So let's do this. We'll find one here and find one there. Let me. So you find one there as well as you find one there. Okay, now if we were expecting, or if we were looking for resistance levels rather, we'll be looking at swing highs and swing lows in line with those major levels. So for example, let me just move this chart up. Okay, we'll be looking for this. Here's a major level here. Here's 112, right? Here's 112. And here is also that 111.50 level. So those are the two levels that we're looking at right now on the upside as our potential resistance areas. Now we need to have a swing high like this or a swing low like that. Right now we don't see anything at 112. If you look back though, we probably could see some previous price action around that area. And if so, okay, you can see here, there was some previous, this was the previous support structure, right? Market bounced off, then just took off to the upside, landed at 114, pulled back in at 112, and then just rebounded again, broke below it, and then came back to retest. It did extend, okay, of which it doesn't usually do so that much, and then ended up at 112.50 before the market dropped to the downside, as you can see. So there would be a significant level as well. So let me just clear this. And then add this to the mix. Okay, boom. This level here, and here's a support, and there's another support. Okay. And let's say as an extension, we're looking for this high at 112.50. Now you have some key levels. This is all just on the 4-hour time frame. And what you'd like to see is the market do what we sort of like plan on doing. Okay, we set out a plan, right? We have a game plan before every single trade, before every single week, and before each trading day starts. We have a plan of if the market does this, then we're going to do this. If it does that, then we're going to do that. And if the market doesn't do any of those things, then the one thing that we do is sitting on the sidelines, right? There's a lot of doings there, but the main thing that you want to happen is if the market reacts or does one thing, and that one thing is in line with what you've anticipated, then you want to do what you actually plan. And if it doesn't do what you plan, then you leave the market alone. So for example, if then we get some sort of a bounce, let's say at 115, 111.50, for example, we looked at 11.15 and we're like, okay, 11.50 is not a solid level for us. We're not looking for any short positions around there. And the market heads up, boom, and gives us what looks like some sort of a double top, some sort of an M formation there like that. And we want to go short, boom. And the market sort of like sucks us in with that pattern. Now that is originally not in the plan, right? That wasn't part of the plan. The only trading areas that we isolated was 112 and 1250 and 110 and 109. Those were the 4 areas that we look for, but now the market is sort of like baiting us in, because it's going to feel like that sometimes. It's going to feel like the market is asking you to get into a move that you're particularly not ready for, and you particularly weren't looking to get into in any case. And what's going to happen is sometimes, okay, not all the time, you might get into the trade, right, prematurely, because you have this fear that it might not get up to this level and the market will just extend higher, and now you have this position still open up. Okay. And if you still have that open up, what's going to happen in your mind is going to be, okay, let me just see how far this one goes. If it rejects here, then I'm definitely going to get out once it comes back to where I entered. I think everyone who's traded live, and then I would think demo as well, has that sort of mentality that when the market goes back to my entry point, that's when I'm going to get out. That's one of the oldest trading adages you can actually think of. And I've heard people say that so many times. I've said that so many times. So I know that in most cases, the market doesn't do what you hope or you pray it will do. So, and one of the other things that you do when, or you miss out on, is opportunity to actually short at this 112 zone. So, for example, if you jumped in too early and the market wasn't ready to get to be sold at that price, and you let it drag you the wrong direction for about 50 or so pips, you miss out on the opportunity because you can't really see any trade setups while you're being dragged the wrong direction. Trust me, when the market is not going the direction you want it to, it will paint the most beautiful trade setup, but your eyes will definitely not see them, because obviously your mind is on overload thinking about the drawdown that just happened. So it's much more potent and much easier to wait for the setup to actually come to you, and then make sure that you execute once it gets there, provided that you get that candlestick pattern that you'd like to see. Okay. Now, I think for some people, it does work having these sort of squiggly lines. I know I make fun of them a lot. These lines where you're like, okay, the market goes up and then I sell here and then it goes down, and I make fun of them a lot, but I also use them, right? And I know a lot of guys who are making some decent profits using them as well. Okay, I only make fun of them because it's just a sense of what we have, this way of thinking that we have, that the market is going to do what we want it to do. Right? That's not the case. Whatever squiggly lines you might draw on the chart, it's just your projection about what could happen in the future, right? And if it doesn't happen, there's no need to be disheartened, because the market does whatever the market wants at the end of the day. So let that be sort of like that guideline towards that trade that you want to happen. And if you had emojis on the MT4 platform, right, you'd probably put an explosion or a flame or something right there. And you're like, okay, the market comes in there and gives me the type of trade setup that I actually want, or the past candlestick pattern that I am looking for, then that's when I'm going to execute. Okay, so for example, if you're looking for a breakout and a V bottom in the Euro USD just above that 112 zone, what we'd be doing is, this. Break, comes in market and retests above that 112, and then continuation move to the upside. Okay, so that's where we'd have that's where we get that V shape from. Okay, I'm just trying to make sure that we keep things simple. So you'd be looking for a V bottom. Right, so that will be in an upward trending market. Now, if we were looking at price rejection, let's say the trend we've analyzed, and it seems like it's heading downwards, then we do this. Okay, now the flames, or the explosion, you'd be looking to happen somewhere there. Okay, and the letter, let's just say M, capital M. And this is just a double top basically. Just for illustration purposes, for us to be able to see it visually, you'd call that an M and call the other one a V bottom, or this one you'd call it double top, and the one that would form somewhere around here, that would be some sort of a W or double bottom, or also a V bottom, because it's not always going to be a double tap. Okay. Right, so that needs to line up with what trend we are currently in when it comes to that particular currency. So if the euro dollar right now is in a short cycle, right? The market is in a short cycle, which means that it's heading downwards. It's heading downwards. It's been doing so for the past couple of weeks, couple of months. So in the long term, in the mid to long term, the market has been positively going down, right? We can see that it's going down. Indicators point to us that it's heading downwards, right? The moving averages are firmly above the price on the daily time frame, and the price is below the moving average. That's one of the easiest ways to actually find it. And other ways, just to look at the swing lows, right? To see these swing lows, are they getting broken? Right, boom, yes, you can see that the swing lows are getting broken. So that's also one key factor that we can take into account when we're determining if the market is in a downward trend or it's in an upward trend. Now, obviously, in a range of market, these swing lows will be somewhat equal. You might see maybe the market extend a bit, but pull back in, then extend down a bit and pull back in. But these swing lows aren't being broken. They're still intact. So that means that the market is still ranging sideways, and there is no clear directional bias for us to sort of like latch onto with a trend trading strategy, for example. Okay. So now we have two things that we would basically look at. Very basic, very simple. We focus on that big figure. We look for that big figure. Is it where we would like it to be? Is it in line with a strong support or resistance level? If yes, then we'll isolate that area. Now we're looking for potential setups around that area. Now there's going to be 2 or 3 more things that you just need to verify before you enter a trade, but that's just about it when it comes to just looking at key trading areas. Right. Guys, remember the topic of today, key trading areas. Now, if you can use those trading areas and use more confluence to increase the probability of the trade setup working out, then you can consistently draw out profits from the market on a weekly basis, monthly basis, whatever that case may be. Okay. Are you guys with me? Is everyone on the same page? Okay, all right, perfect. So, as I was saying, from what we did yesterday, then, right? So, from what we did yesterday regarding those basic candlestick patterns, we tie those two things, and then you already have a large part of what you're actually going to need to do your breakdown of the higher time frames. Okay. That is without the moving averages and all that other funny business, you know, your Fibonacci extension and retracement tools and all of that other stuff. This is just like raw price action, okay, based off what the big players are sort of like into, right? Where the big players are getting into, where they're taking their profits. That's why, as I usually say, when you're going through to the concept of trading major levels or those big figures, round numbers, what's going to happen is you're going to start to see them. Okay, you're going to go into, let's say, a larger time frame, daily, and you're going to see a lot of these swing highs and the swing lows coming in exactly where that big figure is, that round number is. You can see here, boom, there was a swing low. And then the market broke above that 110 and pulled back in. Well, popped just above 1050 and then pulled back in to 110 again and then pushed up and broke right through 111 and then pulled back in from 1150 back down to 111 and then pushed up again, and the market just broke through that 110.50 and then came to tap that 110 zone again. Okay, so if you look back, you're going to see quite a lot of examples, which is why when we actually get into the execution part of things, we're going to be in a position to put our stops where they are going to be the safest we can actually put them. Okay, out of reach of where that 50 pip increment of those round numbers is, that is where the stop loss actually is going to be. Otherwise, if you throw it in too close, as some of you guys will know, it might not work out long-term as a long-term strategy. Okay. You'd rather have a bit of a wide-ish stop and have a decent risk-reward ratio than to have a tight stop, which is going to get you stopped out. And even the trades that you were going to make money on, you end up losing money. Okay. All right, guys. So we are close to finish. We are going to be taking questions in right now. If you guys have any questions, even if it's from yesterday, because I mean, yesterday's session is, this session is more of a continuation from yesterday's session, but with a bit more confusion in it. But I do hope that everyone is on the same page. And obviously, if you guys have any questions, you can ask them now. If not, then you can just throw a message on Telegram. As I was saying regarding the competition, we are going to officially start on Monday. Okay, competition is going to start on Monday. There is a total of 1,000 USD, which was sent in through to me, and I am safely holding on to that. Okay, although it's Black Friday tomorrow, so hopefully I don't get any urges. I'm kidding, guys. But we decided to break that $1,000 up into first prize, second prize, third prize. First prize is $500. Second prize is $300, and third prize is like 200 USD. Okay. Like I said, I won't be. It's going to be a bit of a surprise to people how I'm going to judge um, who actually gets to win the prize, and then how we. Because I mean, it's not going to be a situation where you have to trade whatever funds. Right? If you want to trade them, it's your choice. If you want to take out the money and then you just want it sent through to your account, you can also do that as well. It's not an issue though. But what's more important is that we actually make sure that everyone who's involved in this actually sees the entire thing out to their very end. A lot of guys start stuff and then sort of like when it's a bit tough or they're not understanding it, just quit or just lay off it a bit. It's important that if you're going to be taking part in the competition, make sure you're going to be there till the very end. Okay, because obviously you never know what the criteria for actually winning is going to be. It might not be who makes the most amount of money or the most amount of profits in the shortest period of time. I might be looking at Sharpe ratio. I might just look at Monte Carlo. I might look at, I don't know, there's a lot of things I might look at. I might look at drawdown. Okay, I might look at the average, the win percentage. So there's a lot of different things that I might be looking at in order for me to actually make a decision about who gets to take home the prizes. So I'll send through the details over the weekend and help everyone just finish setup before Sunday. So on Monday we can actually get started with that. And I mean, everyone in the group is obviously it's exclusive to the group. So everyone in the group has access to the competition if they want. You can just send me a WhatsApp message, or you can just send a Telegram message on the 072 number. I can't quite remember. My brain's a bit fried right now. So, okay. So, do you guys have any questions? We have a few minutes left. I'll be sending through some stuff in the Telegram channel as well. I think the fundamental analysis, research and development for the newer guys. It's just sort of like a research type of project that you can do over the weekend. Just go through the internet and find answers to some of the questions that are on the PDF. Okay, I'll repost that again. And one other one which does include a template of the trading plan. Okay, now you don't have to do those right now because that's not what we're doing now, but they do help in just opening your eyes if you like to do some extra additional work. Okay. Okay, guys. Okay. Right now we're not going to touch on too much regarding the stop loss. Okay. The stop loss is obviously one of the most important things that you're going to use in getting, in sort of like trading in general. So you might have, it's sort of like in life, you have a stop loss on your life, just as you would in any position that you actually have. Because what it does, it limits the losses that you can potentially take. Right? So the stop loss needs to be in a place that's going to be safe, that's out of range, that it's least likely for you to actually get stopped out and to see the market go in your direction. Okay. But you don't need to worry about that. Like I said, we're still going to look at that. We're going to look at entry, and then we're going to look at stop loss and how to basically manage a trade once it's on. Okay. Okay. Right, guys. Let me call it an evening, and let me catch up on some reading. I'll send through the documents that I need to the group within the next hour or so, and I'll have the recording up for the guys who missed the first part of the session, so you guys can rewatch this again. Thank you guys very much for coming through, and I will see you guys in the next session. All right, cheers.